It's Brian Preston, the money guy.
We're picking on Brian today, it seems.
Those are always my favorite shows.
Home equity line and cash reserves. Guys, I really had to chew on some leather on this one, is because I was no different than a lot of you guys. And Bo, you just told me the other day, you feel like clients right now are having this feeling about cash is trash.
I have clients all the time asking me, hey, and I think as we forget, the market was so good last year. The market's been so good for the last number of years. We forget, and we're like, why are we holding this cash? Why do we have this anchor holding us down? I just don't need it. It's not serving any purpose. And it makes me nervous when I start hearing that over and over again.
So if you go listen to early Money Guy shows, I'm just going to go and tell you what's out there and what you'll hear. You'll hear me bragging about, I don't keep cash. I had no cash reserves. Why would you keep cash reserves? Because I had a debit card and I had a checkbook to a 6-figure home equity line that was prime minus a half. And at the time, because we've been in a very long period of low interest rates, it was practically free. I mean, I will tell you, the bank gave me this no-cost home equity line on my house. And we even had, and I wanted to show you guys, because I have the appraisal when we did the home equity line. Check this out. You can see back in late 2006, October of 2006, my house back in Georgia was appraised at $510,000. I paid a little below $400,000.
It was a great real estate market.
I mean, it was a great market. I had no cash because I had access to a home equity line. If I got in an emergency, I could always get the money. No big deal. And y'all can see the rest of the story is in March 5th of 2010. It might have been before that, because this was actually, I wrote a letter to Wells Fargo saying, wait a minute,
why'd you
how
do
does this
this to
work?
me?
So they wrote me a clarifying, this is the response letter I got on March 5th, clarifying me when I said, how can you do this to me and take away my home equity line? Is because I did. I got a letter from Wells Fargo saying, look, we don't think you have equity in your house anymore, so we have
revalued it.
We've revalued and we've capped and we've frozen your home equity line. And you can see this was from March 5th of 2010. They appraised my house through their AVM method at $273,500. This is the exact same house that just a few years earlier they'd appraised at $510,000. So by their measurements, I was now probably at break even or maybe even slightly underwater.
Yep.
And that's just not a great place to be, because the music can stop on this. And this is why we've taken a lot of heat also, because we just talked about net worths and we talked about real estate. And look, I think some of you guys took it to the extreme, because I said you can do it at cost or you can use market value like Zillow or something like that. But I choose, and you do the same thing.
Same thing.
I still do it at cost, because I don't want my annual net worth statement having runaway appreciation in what I consider a use asset, meaning there's no way this is giving shelter, this is keeping my family safe. When it rains outside, I'm not going to be able to use these assets because I don't count on equity. It's one of those things. So be thinking of those type of aspects when you're figuring out if you should consider using your equity of your home.
I think it's a great point, because imagine how different your net worth statement looked in 2006 with the home value there versus in 2010 when the home value got cut. Did anything really change in terms of your saving or what you were doing to build financial independence? Not really. It was sort of fictitious value anyway. So that's why we think value use assets at cost, and you will stay conservative. And then if you sell it, downsize, trade, whatever, then you get to recognize that. There's nothing wrong with that. And you say this all the time, Brian. Here's why this is really scary. Generally speaking, bad events do not happen in a vacuum.
Yep.
So if there is an event where the value in your home gets cut by, in this case, like $200,000 or by 40, 50%, there's a chance, too, that your investment assets have gone down. There's a chance, too, that the job economy is probably suffering. There's a chance that maybe even your employment is at risk. You have to make sure you maintain that liquidity and that emergency reserve, because when things get bad, there's a very high likelihood that everything gets bad at the same time.
I want to summarize, because that's the Money Guy teachable tips that I had here. Was really, there were 3 of them. It is understanding the power of liquidity and cash reserves. You got to have cash, because Bo said it right, because I had this. Bad things tend to be batched.
Yep.
You know, what you see is you see a down economy. Property values on your real estate go down. Loss of your job might potentially happen in the same period because it's downsizing. And then your investments are down. So the liquidity is going to be the bridge that gets you to the other side. And then you put timing. Asset classes don't just happen in equities. It kind of reiterates the same point.
We talk about all the time that, a lot of folks think about timing the market as like, okay, when do I go buy stocks? You can also time yourself out of conservative asset classes. Oh, the market's doing really well. I need to get rid of my cash and go fully invest that. That's no different than trying to time the market. You're just timing a different type of market. We think that a well-diversified portfolio should stay well-diversified, and that's what protects you through the long term.